Hi students, today we are discussing the last problem from dissolution of a partnership form. In this problem, it is given that A, B and C are partners sharing profits and losses in the ratio of 3:1:1. They agreed to dissolve their firm. The balance sheet of the firm is given here on the date of dissolution. Creditors loan is there, then partners loan is there. So, and other assets and liabilities are also given. Then it is given that it was agreed that A took over computer at its book value in settlement of his loan. In order to settle his loan was 10,000 and for that he took over computer. Computer its value 8,000. So by settling his loan we will get a profit of 2,000. Then A took furniture at rupees 800. Furniture we have 1,000, it is taken over at 800 by A, and the debtors amounting to rupees 20,000 for 17,200. These two items, furniture and debtors of rupees 20,000 is taken over by A. So 20,000 debtors he has taken over for 17,200. The creditors of rupees 6,000 be paid by him at this amount. That means 6,000 rupees creditors is settled by A. Then it says that B took stock in trade at rupees 7,000 and some of his debt sundry debt assets at rupees 7,200. Then now about B it says that took over stock for rupees 7,000. Stock 7,800 was there and that is taken over by B at rupees 7,000 and some of the book debts or sundry assets, some of the sundry assets taken over at rupees 7,200. That means being 10% less than the book value. So sum of the sundry assets that only is given. Its value is 7,200 taken over at 7,200. That 7,200 is 10% less than the book value. That means this is 90%. Okay. Then C took the remaining sundry assets. So how much is B taken? Remaining amount of sundry debtors, sundry assets taken over by C at 90% of the book value. Less less rupees 100 as discount. Then next says that he also assumes the responsibility for the discharge of loan together with the accrued interest of 30 rupees. A loan was there 1,500 and that will be settled by C by giving extra interest of rupees 30. That means 1,530 is the total loan amount settled by C. Then the expense of dissolution were rupees 2,270. The remaining debtors. So here debtors were there, some 20,000 is taken over by A at 17,200. So total debtors were 26,200. So the remaining debtors, that means 6,200 is taken over, is sold to a debt collecting agency. That means the agency who collect the debt on behalf of somebody. Okay, and they taken that, or it is sold to them at 50% of the book value. That means 6,200 was the debtors. Its 50% means 3,100. Now what we have to do? We have to prepare realization account, then A's loan account, partner's capital account and cash account. Let us see first how to prepare the realization account. Realization account is ready here. First let us transfer all the assets. Then sundry assets first we can write. Sundry assets we have 17,000. Then comes debtors. Debtors we know 26,200. Then after that, stock in trade is 7,800. Now furniture we have 1,000 rupees. Then computer was there, computer 8,000 rupees, that is transferred. Then we can transfer all the liabilities. In liability, first we can write the provision for doubtful debts. We know that provision for doubtful debts, even if it is given in the asset side, it will be transferred along with the liability to the credit side, and debtors will be taken in the gross value, that is taken here. Then creditors we can transfer. Creditors 6,000 is there. Then comes loan. Loan is there. How much? Loan we have 1,500. Okay. So these are the situation. Now we have to write the realization of assets. Okay. So first here it's given that A took over computer at book value to settle his loan. That let it be. Then we will write. We have to write that also. First we can see the remaining assets. A took over furniture at rupees 800. So we can write A's capital. In A's capital, furniture he is taken and debtors also. So we can write one by one down. Furniture 800 he is taken, and then debtors amounting to rupees 20,000 he has taken for 17,200. So total comes 18,000. Okay. Then he agreed to settle creditors. So we can write to A's capital, creditors taken over at 6,000 rupees. Okay. Then now we can write A's loan. So A's loan for taking over, he has taken over computer. So we can write by A's loan, computer is given. Computer how much? 8,000. So we have got a gain. How much is the gain? 2,000. That 2,000 gain we can write here. Can write A's loan. That means in A's loan we will write to realization for 8,000 taken over computer and 2,000 gain. Instead of that you can write completely. That means to A's loan. In A's loan we can write to realization 10,000 also. Okay. That's not a problem. Now let us see about the next point. B took over stock in trade. He took over stock in trade. We can write to B's capital. Which are the items he has taken? Stock in trade he has taken for 7,000 rupees. Then and some of the sundry assets. Some of the sundry assets he has taken for 7,200. Okay. So total 14,200. Okay. Now B's case also over. Now it says that C took over the remaining sundry assets. So we have to find the remaining sundry assets. We can find out by writing a working note here. So working note we can write here. Working notes. Book value of sundry assets taken over by B and C we can write. Out of that book value of total sundry assets, we have total sundry assets 17,000. Out of that how much is taken over by B? B taken over, the book value of sundry assets taken over by B is equal to 7,200. That it is given that is 10% less than the book value. 10% less than the book value means it is 90%. So if 7,200 is 90, then what is 100? So the book value is 8,000. That means out of 17,000 book value of sundry assets, 8,000 is taken over by B. Then how much is left for C? That is 9,000. that we can write here. Book value of sundry assets taken over by C is equal to 17,000 minus 8,000, that is 9,000. Okay. Then this sundry assets is taken over by C at 90% of the book value minus 100 rupees discount. Okay. So we can write that book value of assets, remaining sundry assets taken over by C is equal to 90% of book value minus 100. That means 90% of the book value is 9,000 divided by 90, or 9,000 divided by 100 into 90, that is 8,100. That means 9,000 was the amount of book asset at that time remaining into 90%. 9,000 into 90%, 8,100. Out of that 100 is discount. So the amount of sundry assets taken over by C is 8,000. Okay. Then this we can write here, sundry assets taken over by C. We will write by C's capital, sundry assets taken 8,000. Okay. Now debtors, sum of the debtors taken over by A along with the furniture, that here we have written 17,200. Then here it says that remaining debtors were sold. So we have to see the remaining debtors, how it is calculated and sold. So debtors realized can be calculated like this. Total value of debtors we had 26,200. Out of that, how much is taken over by A? A taken over 20,000. So we know that normally remaining sundry debtors is 6,200, and that is sold at 50%. So 50% of 6,200 is equal to 3,100. So that we have to take 3,100. Okay. That can be written here by cash. By cash in bracket, if you want, you can write debtors, that is 3,100. Clear? Okay. Now let us see here. A's capital we have written creditors taken, and there it says that C agreed to pay loan with the interest. So loan we had 1,500 plus interest 30 rupees. So we can write C's capital. For understanding, it is written here loan with interest 1,530. Okay. Now again it says that expense of realization was 270. That is paid by cash. So we will write to cash. How much? 270. Okay. This is all the adjustments in realization account. We have entered all the adjustments. Now we have to see that which side is showing more amount. Which side shows more amount? Let us see here. Yes, which side? Debit side shows more amount. So we can total there. So 67,800. That will be transferred to credit side. 67,800. And the balance 5,800. That will be shared among partners, and it will be shown in their capital account, debit side of their capital account in their old profit sharing ratio. So capital accounts A 3 by 5, that is 3,450. B 1 by 5th, that is 1,160, and for C again 1,160, that is 1 by 5th again. So this is the loss of realization account. We have transferred it to the capital account of partners. Now let us prepare the next one, loan account. Whose loan account? A's loan account we have to prepare. So here A's loan account is ready. Opening balance we can write by balance brought down. How much was the balance brought down? 10,000. So for that 10,000, we have paid computer for 8,000 rupees. There we have written. This computer was shown there in the realization account as by A's loan. That's why computer is taken here. That means loan is settled. 10,000 loan was there. That was settled for 8,000 rupees. So if a loan of 10,000 is settled for 8,000 rupees, there will be a profit. That also we have credited in the realization account for 2,000 rupees. Now total 10,000 rupees. So the loan account is closed. So we know that partner's loan account will not be transferred to partner's capital account. Loan account is separate and capital account is separate. That's what we have seen here. Now let us prepare capital account of partners. Partner's capital account. Partner's capital account is ready here. Okay. Let us write the opening balance first. By balance brought down for A, B and C. It is there in the balance sheet. 27,500, then 10,000, then 7,000. Okay. Now what we have to do? We have to write realization. That means liability is taken over. Liability is taken over by whom? By A and C. Both have taken liability. So we can write to realization in A's column 6,000. That means creditors paid. And C paid the loan. Okay. So loan and liabilities both are written here. Understood? Then let us see the debit side. Debit side we have the journal entry here. Assets taken over. So we will write to realization. So assets taken over by all the three partners. Okay. So 18,000 for A, for B 14,200 and C 8,000. Is it clear? Here it is there. 18,000 A taken over furniture and debtors. B, then here B taken over stock in trade and sundry debtors, sundry assets 14,200. Then C took over remaining sundry assets. So that is 8,000. So these are the entries written here. Okay. Now let us see realization loss. Realization account loss. Loss we have shared and written there in the credit side. Okay. 3,480, 1,160, 1,160 again. Then furniture. Furniture is taken over. Okay. So we will write here. Sorry, furniture is already adjusted. Already taken here, assets transferred to A, B and C capital. So now we have to write, we have to balance the account. So here in the case of A's capital, if you see credit side is more, so we can total credit side and that amount can be taken to debit side 33,500 and can see the difference 12,020. Okay. So what it is? This is the cash to be paid to A. So we can write to cash. Then let us see B's capital. B's capital account debit side is more. We can total there and can be taken to credit side. Credit side 15,360. Then minus 10,000, 5,360 will be there. That can be written here. So the deficiency brought in by B 5,360. Then let us total C's capital account. Here C's capital account, if you see, debit side is more 9,160, that can be totaled and can transfer to credit side, and the balance we will get 630. Okay, so the capital account is over. Now it shows that B and C should bring cash into the business and firm has to pay money back to A. Then let us see the cash account. Cash account of partners, cash account of the business, we can write it as opening balance of cash we have in the balance sheet. We have in the balance sheet, first item cash, we have 3,200, that is written 3,200. Then cash brought in by C, we can C and A we can write. First let us write amount brought in by B. So B's capital 5,360, 5,360. Then cash brought in by C. So C's capital 630. Then debtors realized, that we can write to realization. Debtors realized for 3,100. Then realization expense, credit side realization expense we paid 270 and A's capital 12,020. That is the amount paid to A. Okay. Then let us see the total. Cash account total 12,290. So this is the way of preparing realization account, capital account and cash account. And the speciality here is that part of the assets are taken over by partners and the remaining part may be either taking over by other partner or being realized. So you have to understand it thoroughly, that how to treat the part of the assets if taken over by partner and remaining part is realized. Okay, that is the speciality of this question. You can write down the question in a separate paper and can solve it yourself, and after that you can compare that answer with this answer once again and can solve such type of problems from your reference book. Thank you.